Okay, hello everyone. Thank you for joining us today on this episode of the On the Mark Financial Forum and Podcast. Today we are talking about the topic of deferred maintenance in co-op and condo buildings, otherwise known as SWARMP for those of you in New York. And it's a really important topic. It's become a very, very prevalent issue. We've come across it on probably close to about 25% of the transactions we've had in the New York City area recently, and it's becoming more and more and more common of an issue that we have to deal with. So I wanted to start to give you a little bit of background on why this issue came up, why banks care about it, and what we need to do to address it. So first of all, this all came out of the condo that tragically collapsed in Surfside, Florida, in 2021. After that, that incident where close to 100 people passed away and all sorts of other issues resulted from that. Banks started getting a little more cautious with this type of issue to make sure that the buildings that their collateral is in is well maintained and that it's not going to have that type of catastrophic issue. That collapse caused over $1 billion in damage, tons of lawsuits, all sorts of resulting issues that are still lingering today that we don't hear about in the news because it's not the most recent news story. But there are still issues that are playing through for that issue to this day. So how did banks react and why? Why did they react? I think it's important to have that context. So first of all, imagine you're the lender and all of a sudden half of a building collapses and your collateral is basically gone. So what do? How do you enforce that mortgage? There are probably lots of lawsuits pending from injuries or against the building for improper maintenance of the property. And what can result from that is, financial collapse of the building. I mean, there's a whole, domino effect of how these things can be able to impact things, including imagine if you were in that building and fortunate enough to not have your part of the building collapse. You're probably not going to want to pay your common charges. And I would imagine that the value of your property just dropped substantially, knowing that half of the building next to you collapsed, right? So there's all these issues that lenders care about in trying to assess that risk. And so the way that banks responded is they created this new guideline about what they classify as deferred maintenance of a building. And they started asking questions on a condo or co-op questionnaire that pertain to this issue and trying to uncover which buildings have these types of underlying issues and which ones do not. One of the issues that we'll discuss later is that deferred maintenance is a very generic term, right? That could mean paint chipping. It could mean anything. It could mean a pipe leaked for 5 minutes and needs to be, resealed. It's very, very generic. So that's leading to some of the challenges that we're having with lending is that there's not a clear definition and it may be different in different cities as far as what the legal requirements are for maintenance of a project. So banks started asking questions on a questionnaire that they didn't ask previously. That's why this issue is relatively new. So they'll ask questions like, are there any current or planned special assessments? And if the management company answers yes, then they'll want to know what's the reason for the assessment and what's the total amount of the assessment. So they're basically, they are probing with questions to try to uncover whether there's an issue here that they need to address. Are they related? If there are any assessments, are they related to the condition of the building, anything that relates to habitability or anything like that? And if the co-op or condo has been issued any type of engineer's report that may show any deferred maintenance. And if the answer to that is yes, then they're going to ask for a copy of the report. So you can see lenders are starting to probe these questions to uncover whether buildings either have a formal issue with the city where there's an actual violation, or if maybe there's some issues that they're still dealing with that would meet the classification of deferred maintenance. So more recently, Fannie Mae and Freddie Mac came out with a definition of what they consider to be critical repairs, which is basically the definition of deferred maintenance. And I'm going to read this to you so you can understand exactly where they're coming from. So it says here, projects in need of critical repairs are those needing repairs or replacement that significantly impact the safety, soundness, structural integrity, or habitability of the project's buildings, or financial viability or marketability of the project. Critical repairs include conditions such as material deficiencies that need to be dealt with within 1 year, mold, water intrusion, physical deterioration. There's a whole list of things here, but there's a couple of references specifically to the term of 12 months. So they're probing for information about projects that have been deferred that the person who's filling out this questionnaires, it's really up to their opinion. If it's not a government mandated requirement, as to whether that critical repair is something that has to be addressed within that 12-month period. And that's a really critical factor, because if something could be a deferred maintenance project that really isn't urgent, that could be done anytime in the next few years, maybe the co-op or condo building is already raising money over time to pay for that repair, but they're just not starting the actual work yet. And Fannie Mae and Freddie Mac would not define that as deferred maintenance, even though, and this is one of the issues that we'll be talking about, even though a management company may say, yes, that is deferred maintenance, because deferred maintenance is a general term. There's no specific definition put on that from the managing agent's perspective. And that's one of the disconnects that we're starting to see. And I'll tell you about a case study that we dealt with where we found that to be the case. And that's been a prevalent issue in general. So as you can see, some of these definitions are vague and they're left up to interpretation. And what's happening is some banks are taking a more conservative approach than others. So retail banks tend to be more conservative on most things than lenders like us and others that can take a little bit more common sense approach and not just look at the checkbox and say yes or no, black or white. We can listen to a story and try to make it work. So we're going to talk a little bit about specifically New York City, because New York City is such a prevalent area for co-ops and condos. Most of the properties are buildings that may have this type of issue. We're going to talk about, for just a few minutes, New York specifically. So many of you who may be tuning in from New York may be familiar with Local Law 11. It's been a hot topic for a while. And what happened is the city requires that buildings that are 6 stories or higher have to have a mandatory inspection by an engineer, qualified engineer, called a Qualified Exterior Wall Inspector, QEWI. Maybe you've heard of that term. It used to be every 10 years they had to have that requirement. And then there were some incidents where bricks or materials were falling off of buildings and injuring people, or worse, potentially. And so what happened was they now require it every 5 years. So imagine if you're inspecting buildings twice as often, you're likely to find twice as many issues. And that's why, in my opinion, we've started to see this pop up so much more, because Local Law 11 switched to every 5 years. And now you're seeing more and more and more buildings have these types of issues that they're uncovering, which is, in the big picture, it's a good thing. Obviously, it creates some challenges for lending, but it's a good thing to make sure that people walking on the street are safe, because if we're the ones walking under those buildings, we'll want to feel safe as well. So you have to have all of the buildings with 6 stories or higher inspected every 5 years. And then the QEWI inspector basically has to give it one of three ratings. The safe rating, which basically means that there is no sign of deterioration, that no repairs are needed within a 5-year window. Many of you have heard of the second designation. It's called SWARMP, SWARMP, which means safe with a repair and maintenance program. Basically, what that means is that that work needs to be done within 5 years, so it's not immediately dangerous, but there are signs of deterioration that will likely deteriorate to the point of needing to be fixed within the 5-year window. And then you have the dreaded unsafe designation, which basically means that more significant issues were found that, according to the city and the QEWI inspector, need to be done within 12 months. So that's the one that banks are very cautious with, and that is something that can definitely derail a transaction if you're not working with the right lender. So repairs are generally expected to be done within 90 days when you get an unsafe designation, but they can request an extension to that timeline depending on the extent of the work and how they need to raise funds. But imagine if you're in a building or you're listing a unit in a building, when you get that unsafe designation, imagine you've got to do facade repairs. The likelihood of being able to get that completed within 90 days is not likely because, first of all, you have to figure out how you're going to pay for it, right? That will likely require board approval of an assessment or a loan or whatever it may be, which can also take time for a co-op or condo to obtain. Then you have to actually have people bid on the job. And then you have to hire them, and then they might not be available the day that you say, yes, we want to go forward. Obviously, they're probably booked up maybe several months. So you can see how this can kind of play out. I would imagine some major projects that need to be done where an entire facade may need to be reinforced could theoretically, with all these steps, take a couple years. I don't think that's unreasonable. But what's going to happen is those buildings are going to remain in an unsafe designation and possibly even show a secondary unsafe designation if they haven't met the 12-month timeline. So it can cause a lot of issues for financing because in the event you have an unsafe designation, that means that the building does meet Fannie Mae's requirement for deferred maintenance, right? Which is a project that needs to be done within that 12-month window. Where we're seeing a little bit of a gray area is in the second designation, which is the SWARMP, the Safe with the Repair and Maintenance Program. So what we often see happen, I'll give you an example in a minute, is that managing agents will say if they have a SWARMP designation, which means that the building's okay for now, but needs work within 5 years, they're still classifying that as deferred maintenance, right? And if you're working with a lender or a retail bank where that questionnaire goes directly to their project approval team, there's nobody looking at it, there's no one questioning whether it was filled out correctly, you can sometimes end up with an unnecessary declination. And managing agents, if you put yourself in their shoes, and we did try to get a handful of them to agree to come on to be co-panelists today, but to no avail, unfortunately. But the problem is that they don't want to take on the liability of saying, no, there is no deferred maintenance when they have a SWARMP designation. So they're trying to cover their tails, so to speak, from a legal standpoint and saying, yes, the building has a deferred maintenance program, SWARMP in place, and they're checking the box saying, yes, there is deferred maintenance. And that's going to lenders and buildings are getting declined. But that shouldn't necessarily be how it works, right? There should be some clear definition of what exactly that means. So, and that's partly why you see some lenders that are declining buildings and others that that are being a little bit more common sense, I would say, about being able to approach the component. So So there are just a ton of buildings. I want to share my screen here and show you guys how many buildings this is actually impacting. So bear with me a second here. Okay. So I'm showing you my screen, and I'm gonna send everyone who's registered for this session a link to this website, which is basically for New York City. It's a map of all of the buildings that are designated as safe, SWARMP expired, which means that it's been 5 years and no work has been reported to be completed, or unsafe. And you can see there's about 15,000, almost 16,000 buildings in New York City that meet this requirement of basically being 6 stories or higher. You can see on this website, it's pretty cool. You can see about 4,500 of them have been deemed safe. About 45 of them have no report filed yet, which could be a different issue. 3,600 are designated as SWARMP, which is needing repairs within 5 years. Almost 2,000 buildings are designated as unsafe, and over 1,000 have a SWARMP designation that has now expired with no resolution. So if you look at it from that perspective, and for those of you who can see my screen who are attending this session live, you can see the screen is full of dots, right there. And I'm not even including the buildings that are deemed safe. If you look now, these are the ones deemed safe. These are all the buildings that could be problematic. Okay, now, typical of a government website, there's no way to search this by address. So you actually have to find a building on the map based on, where you're looking, and click on the button, and it'll show you specifically if that building is deemed safe or unsafe. Here's an example. This one's unsafe. And it shows you some of the dates that the reports were filed and all that. So, but I mainly wanted to show you this just to show you the magnitude of this issue. It is literally thousands of buildings that have some sort of work project required to be done according to a government filed document. I also want to show you just really quickly, for those of you, again, in New York City, who want to know how to find more detail on this project. If you go to the DOB Now website, which you can just search in Google and you'll get right to it, you can search by address, and then it pulls up some of the details. And if you go to the very bottom of the page, you'll see safety and compliance filings, and you go to the facade section, click on the very first one, and you'll see here's an example of a building that has an unsafe designation. So originally it was accepted as SWARMP, meaning there were repairs needed within 5 years. That was 5 years ago, and now they had a new inspection, now determined to be unsafe for this specific example. Obviously, every building is different, but what you want to make sure of is that you're checking these things ahead of time, right? So, and we'll talk about what agents and buyers can do to try to mitigate this issue. And I'll definitely share a link to both of those websites with people afterwards, so you don't have to worry about copying the URL. So the issue, again, is that some lenders are taking a different approach with this than others. So some are saying, well, SWARMP means that the city has a filed report. And of course, if you look at that report, it always looks worse than the actual situation is. Any engineer's report, if you do a home inspection, it's the same story. They have to call out every single issue, every brick that's, loose. So sometimes those reports can actually scare a lender into declining a building, even if it doesn't meet Fannie Mae's definition of deferred maintenance. And another thing to keep in mind is that a lot of lenders, even if they're not doing a jumbo loan, they take Fannie Mae and Freddie Mac guidelines and adopt them to other types of loans as well. So just because it's not a Fannie or Freddie loan doesn't mean that that particular lender or program is not going to follow Fannie Mae guidelines. So some potential workarounds. Again, some lenders are taking this very conservative approach. Others are taking a more common sense approach to this issue. I can speak for our company. any SWARMP designation that is not deemed unsafe, where the project needs to be done within 5 years, we have already confirmed internally we are fine with those projects. As long as there's no other issues, we can work around that, even though other lenders may have an issue with it. Every once in a while, you'll have a building that had a questionnaire filled out before the SWARMP designation or the unsafe designation was filed. So they had information that was available, let's say a couple months ago. We've had a couple of transactions where the unsafe designation got filed right after somebody went into contract. So it's a moving target sometimes. But sometimes we get a little bit lucky and we have a building that's already approved that doesn't require any additional documentation or questionnaires that might bring up these issues. So sometimes we can work with a lot of the different programs that we have, because we're not a retail bank. We're not only offering one product, one approved list. We're looking at several, 20, 30 different potential options for that client. So we may find that it's already approved with one while it's not approved with another, or maybe even declined with another. And we can target the loan to be able to utilize that program where the building's already approved. You have to be a little careful about that with retail banks. And this is a little bit of a hearsay story, but an industry friend basically informed me that even if they have a building approved, this is somebody that works at a retail bank, even if they have a building that's already on their approved list, if when they get the appraisal back, if it shows scaffolding in the photos or mentions anything about repairs happening to the exterior of the building, they're going to require a new questionnaire. Okay, now we don't have that requirement, but that's something to watch out for. So even if you have a, I can't mention by name, but you have a big retail bank that says, oh, you don't have to worry about this because we have a questionnaire that says it's not a problem, but you know that there's scaffolding, or you know that there's some other issues that the managing agent might mention in the documentation or due diligence, then you have to be careful, because you could run into a problem midstream. That's something that we've circumvented, but a lot of retail banks, again, are taking a more conservative approach. The other workaround that we have is that some of our programs ask much more vague questions. They're not asking like the ones that I mentioned earlier about, is there any filed reports? Are there, is there an assessment that may deal with, an issue with the building? So some of them ask more, especially like our credit unions and other banks that we work with that are a little more lenient. They'll ask vague questions like, are there any issues with the soundness or the safety or habitability of the building? And oftentimes management companies, if that were the case, they would force people to move out, right? If there was a really serious issue, which almost never happens, but if there were a really serious issue, the city wouldn't allow people to continue living in the building. So sometimes those general questions about safety and soundness, you might get a different response from a managing agent than you get from questions that really probe at a very specific issue, in part because these other lending programs that we have are not driven by Fannie Mae guidelines. They're still interested in knowing, listen, are there any major issues with the building that we need to be mindful of so our collateral doesn't vanish in an extreme example? But they're comfortable with just knowing that the building in general is okay, because most of the time, these issues get dealt with eventually, and then people move on with their lives. So, but the issue that we see most often is one that I touched on briefly previously, is that managing agents don't necessarily know or accept the same definition as what Fannie Mae says, as far as the 12-month window, as far as what does it mean if there's some sort of water damage. If you had a leak in one apartment, does that specify that you should indicate that there's deferred maintenance? Again, there is definitely a pretty large gray area as far as how managing agents fill out those questionnaires, and sometimes we have to educate them. So I'll give you an example. So we had a client named Andrew who was buying in a building that was designated SWARMP. And the questionnaire came back saying that there was deferred maintenance. Now, this one was definitely a Fannie Mae loan. It would have created some issues if we had to switch it outside of there. The terms might not have been as good. Um, and the building was already listed as declined on some of our investors' lists. So basically, we inquired further when we got the questionnaire. We inquired further to find out what are the issues. We talked to the agent, talked to the attorney from the due diligence, and then the management company. And we found out that basically they were filling it out incorrectly. So what we did is we sent them a direct link to Fannie Mae's website and said, this is a Fannie Mae loan. This is the requirement. If you feel that the building does not meet this criteria, then you need to change the questionnaire, right? That's a tall order for a management company after they've already filled it out saying there is deferred maintenance. We were basically showing them, in our opinion, why they should have filled it out differently. And in that case, they did. And we were able to overcome that issue. The loan closed with the great rates, and client was very, very happy. And we overcame the fact that it was actually declined with other lenders. So this is an example of who you're using for the mortgage, whether you're the agent recommending it, the attorney, or the client. That can have a significantly different outcome depending on what the circumstances are. We had another example, which is actually the building that I shared on the DOB website just a minute ago, where the building got an unsafe designation after we had already started the application, but before we got the questionnaire from the managing agent. So what happened was that building, when it's an unsafe designation, it definitely does meet the requirements from Fannie Mae. And lenders that follow Fannie Mae guidelines to have an issue with that building because that work needs to be done within 12 months. We took a look at the report. It was very clear that there were some pretty significant issues with that facade. So there was really no working around that. But we went to the managing agent with a new questionnaire from one of our credit union programs that had a good rate. And basically, that was one of the ones that had the questions about safety, soundness, the more general questions, which was actually a question that the managing agent had answered on the prior questionnaire for the original lender. And they had indicated that no, there were no issues related to the safety or habitability, any of those types of issues. So we had them fill out the questionnaire for the credit union, and they answered the same, no, it doesn't have safety or soundness issues. And so we were able to get that building approved by this investor. And the client's terms were a little bit worse, but it was a situation where the seller knew that they were going to have an issue selling this property to any buyer because of that unsafe designation and the fact that most lenders are not going to work around that unsafe designation. For the most part, that's a nail in the coffin, so to speak, for retail banks for sure, but others as well. And we were able to get it approved, and the buyer and seller worked something out where the seller covered the additional cost of the mortgage for a couple of years before this issue would likely be behind everyone. So we've had some good success working around this issue, but it requires a lender who can be very flexible. And we have since then also developed new relationships with local banks who just understand how it works, specifically in New York City and the surrounding areas, where even with an unsafe designation that they would be perfectly aware of, as long as they see that the co-op or condo is addressing the issue, meaning they're raising the funds, they're interviewing potential contractors and getting bids for the job, or maybe they've already started the work, but it's not complete. They're comfortable with those projects as long as we can show that work is being done to address the issues at hand. So we have a number of potential workarounds. Some will be probably more appealing to clients than others. But our goal is to be able to get that deal to closing and to make sure that we can accommodate the sale without having to wait a year or more for that unsafe designation to be lifted. So basically, one of the main purposes I wanted to have this call today is to talk through how can people stay ahead of this issue. So if you're an agent, which is probably the majority of the people on the call today, I would suggest that before you go to a listing appointment, you check the DOB website and the SWARMP map, and we'll give you both of those after the session. Check both of those to see if there's any issues before you go to that listing appointment. Because if you're the one that comes in and says, hey, we have this issue that we need to work around, and you want to engage with us potentially ahead of time, speak with us about whether it's something we might be able to work around. Knowing that going into your listing appointment is going to give you a distinct advantage over anyone else because you're in the know, you've done the research, and you're hopefully going to win that listing because of that upfront work that you did. If you want, you can just send us an address and we can search it for you. That's a service we're more than happy to provide. And also when you hit a snag with another lender, don't assume that the deal is dead. Let's try to keep the client focused on getting to the finish line. That benefits the buyer and the seller. And call us and maybe we can work out some sort of arrangement where we can get the building approved even if it has an unsafe designation. And you want to, again, watch out for banks that may be unnecessarily declining the buildings just because the managing agent isn't aware of that definition. But you have to be very careful with waiving contingencies. So this is a new issue. I know a lot of times, especially in a seller's market, sellers really strongly prefer that buyers waive their contingencies, whether it be for loan approval, for appraisal, or for the building itself. I would be very hesitant in this environment to waive the contingency if you're on the buyer side of the transaction, as it relates specifically to building approval. Maybe you can waive the loan contingency for anything other than building approval. I've seen that happen before. And maybe you waive the appraisal contingency if you're putting enough down to where you're not concerned about the values. But the building side of this can be tricky because in one of the examples I gave you, the unsafe designation happened after we were in contract, right? And that's not something you can control or necessarily anticipate. Sometimes the managing agent might not give you that information in due diligence questionnaire, or maybe you know that there's work done, but you don't know that it's going to be deemed unsafe during the process, and it can create an issue. So I would definitely caution people to be very careful about completely waiving all contingencies, especially in New York City with this particular issue looming and becoming far, far more common. You really have to be careful with this if you're on the buyer's side. If you're on the listing side and you already have the listing, I would suggest, again, sending us the address. We can take a look at it for you, or you can look it up yourself on these websites if you prefer. But you need to be checking this ahead of time. Same thing if you're on the buyer's side and you're putting in an offer on a building. I would suggest the agent maybe, not involving the client necessarily if you don't want to, but just do your own search on the building, see if there are any issues that could affect how much you want to offer, whether your client even wants to buy in the building, if you want to waste all your time going through the offer process only to find out that you have this issue later. The earlier you uncover these problems, the better. So I definitely recommend check it yourself. Contact us, we'll check it for you. It's a very simple and easy search to do. Despite that map having so many dots on it, we can find it in other ways. But there are solutions. That's the important thing to take away from here. So if you manage the process well, you help your clients, whether they're on the buyer side or seller side, there are ways to work around this. Where we find the biggest problems is where people find out about it later in the process, and then they get very hesitant about the purchase. So these things are always, like most things in life, better to deal with ahead of time. So that's all I have for today. I'm sure there will be scenarios and questions that come up. You can certainly reach out to us on email or give us a call or connect with us on social. But I know that this is an issue that is going to be plaguing, especially New York City, for a very long time. And also any other markets like Florida, where you have a high percentage of, higher rise apartment buildings. This is going to become a much, much more prevalent issue as we go forward. So I do see here a quick question from my good friend Jeff. Any idea how long after work is completed and paperwork submitted to the city do they update the designation? Asking for a friend. I'm sure you have no transaction that relates to this, Jeff. I don't know specifically, but I do know that once the qualified QEWI inspector says that the work is completed, they can file the report to show that it's complete. In my opinion, I think we would be able to work with that for the purpose of closing the transaction. As far as how long the city will take to actually recognize that and accept it formally on their website, I can't say for sure. It's a government agency, so nothing tends to work quickly. But if you have verification that the work has been completed, then I think from our perspective, that would be sufficient to show that that we don't have an issue with deferred maintenance. So if there aren't any other questions, I think we're going to wrap up today. But I appreciate you guys joining us for this episode of the On the Mark Financial Forum and Podcast. And we'll look forward to seeing you guys next time. And anyone who has questions, you know where to find us. All right, take care. Have a great day.